In this video, we will talk about the latest financial trends in a clear and informative manner. Today, we're taking a closer look at Sofi Technologies and its stock performance. We'll explore why I'm leaning towards a bullish stance on this stock, considering the recent developments in market dynamics. So with all that being said, let's begin with today's topic. Sofi Technologies has been making waves as a digital bank, carving out its own space in the financial sector. This has caught the attention of many in the stock market, and for good reason. The company's CEO, Anthony Noto, whose experience in investment banking at Goldman Sachs, coupled with his roles at Twitter and the NFL, brings a unique blend of financial expertise and strategic vision. One key factor driving Sofi's growth is its strategic acquisitions. The company's acquisitions have expanded its capabilities and positioned it for future growth. These moves highlight Sofi's commitment to innovation and its determination to provide comprehensive financial solutions. What sets Sofi apart is its business model, which centers around cross-selling and upselling. Unlike traditional banks, Sofi aims to provide a holistic suite of financial services to its growing member base, resulting in substantial revenue growth and an enhanced market position. Now, let's talk about a recent shift in perspective regarding Sofi's stock. Sofi's consistent introduction of new products and its untapped potential, especially in the realm of home loans, have captured my attention. The company's ability to innovate and tap into new markets has been impressive. Tangible indicators of progress are evident in Sofi's app rankings. The improved user satisfaction and engagement reflect the effectiveness of the company's efforts to enhance its user experience. This could translate into stronger customer loyalty and broader adoption of Sofi's offerings. Now, let's get into why I'm feeling bullish about Sofi's stock. One key aspect is my anticipation that Sofi will strategically optimize its customer acquisition costs. This could significantly impact the company's profitability in the long run. Consider the broader market landscape as well. Traditional banks are struggling to adapt to the preferences of younger consumers who seek tech-driven and user-friendly solutions. This trend strongly favors Sofi's digital-first approach. Furthermore, Sofi's recent acquisition of Galileo adds to its appeal. This move enhances the company's technological capabilities, paving the way for more innovation and customer-centric features. Quantitatively, a recent analyst rating upgrade by J.P. Morgan is a positive sign. The increase in the target price from $8 to $10 suggests growing confidence in Sofi's potential. Taking a closer look at Sofi's current stock performance, it's currently experiencing a slight dip of around 1%. However, in comparison to other growth stocks, Sofi's resilience is commendable. Interestingly, trading volume is relatively low, indicating a temporary reduction in activity from larger investors in the secondary market. This cautious stance from institutional players could be a result of various market uncertainties. What's intriguing is the activity among retail investors. While there has been some selling, there's also been an uptick in buying recently. This balanced activity suggests a mix of profit-taking and a recognition of potential opportunities. Adding to the positive sentiment is Sofi's recent introduction of FHA loans. These loans target low to moderate income families, a strategic move that could expand the company's customer base. While there might be concerns about risk, this move aligns well with Sofi's mission of providing comprehensive financial solutions. The world of finance is a complex ecosystem influenced by a multitude of economic indicators and external circumstances. Fintech stocks, such as Sofi, are not immune to these forces. High interest rates, soaring inflation, the specter of rising unemployment, geopolitical instability, and the absence of quantitative easing collectively cast a shadow on the prospects of fintech companies. Let's delve deeper into each of these factors and examine their potential impact on the likes of Sofi. When interest rates rise, the cost of borrowing money goes up. For fintech companies like Sofi, which thrive on lending money to consumers and businesses, this can have significant implications. As borrowing becomes pricier, demand for loans could decrease. This might translate into a slowdown in new customer sign-ups and dampen revenue growth. Additionally, the attractiveness of borrowing could diminish, leading to potential contraction in loan originations. Inflation erodes the purchasing power of money. As the cost of goods and services climbs, consumers have less money left over for discretionary spending. Fintech platforms, like Sofi, often rely on transaction volume for their business model. Reduced consumer spending due to inflation could lead to a decline in the number of transactions, potentially affecting their top-line growth. Moreover, the affordability of loan repayments could be impacted as consumer budgets tighten in the face of escalating prices. Even in an environment with historically low unemployment rates, the possibility of a future uptick remains. In such a scenario, the financial health of consumers could deteriorate, leading to an increase in loan delinquencies. Fintech companies that offer personal loans or refinancing services could be particularly vulnerable. Moreover, reduced consumer confidence amid rising unemployment could lead to decreased utilization of financial products and services offered by these platforms. Geopolitical tensions and uncertainties can send shockwaves through financial markets. Fintech stocks, just like other equities, are not immune to market volatility driven by geopolitical events. Unpredictable shifts in investor sentiment can trigger rapid fluctuations in stock prices. Additionally, these uncertainties can disrupt international partnerships and expansion plans for fintech companies operating across borders, potentially curbing their growth trajectory. Quantitative easing involves central banks injecting money into the financial system to stimulate economic activity. The absence of such measures can result in reduced liquidity and higher borrowing costs. This may pose challenges for fintech companies seeking funding for expansion and innovation. Limited access to capital could hinder growth plans and curtail new product development initiatives. While the aforementioned factors do present a challenging landscape, fintech stocks possess the ability to adapt and innovate. Fintech companies like Sofi have demonstrated resilience by pivoting their strategies in response to changing market dynamics. While risks remain, they also have the potential to identify growth opportunities in these shifting conditions. In a world characterized by high interest rates, inflation, the prospect of rising unemployment, geopolitical instability, and the absence of quantitative easing, fintech stocks like Sofi find themselves navigating a complex environment. While these factors can impact revenue growth, customer behavior, and investor sentiment, the fintech sector has exhibited an impressive capacity to adapt and evolve. It's essential for investors and stakeholders to recognize the interplay of these factors and their potential collective influence on the future trajectory of fintech stocks. Overall, Sofi Technologies is positioned for growth. Its strategic moves, focus on customer satisfaction, and innovative strategies are all contributing factors. While no investment is without risks, the overall outlook for Sofi appears to be on an upward trajectory.